Hello, I'm Debbie Lovewell-Tuck, Editor of Employee Benefits, and welcome to this Employee Benefits Wired. Today's debate will focus on the potential impact of the new Conservative government on pensions. Under the last government, we saw some of the biggest changes to pensions in recent history, including auto-enrolment and the new pension flexibilities that came into effect in April this year. So what does the future hold for pensions under the new Conservative administration? To help answer this question, I'm joined by Jonathan Watts-Ley, a Director at Wealth at Work, Tim Middleton, Technical Consultant at the Pensions Management Institute, and Chris Curry, Director of the Pensions Policy Institute. So, welcome. So what challenges are employers and employees currently facing, which the government will need to address? Jonathan, I know you had some views on this, so if we could start with you.
Well, I think clearly freedom of choice is a big one that's out there right now. So there's a lot of employers not quite knowing what to do. There's a lot of employees certainly not knowing quite what to do. So I think that's going to be a real challenge to work out actually how those freedoms and those choices become a reality for those employees and those individuals. I think there's some other issues as well around things like auto-enrolment, because I think that we know that even though the contributions are going to 8%, everybody accepts 8% isn't enough. So I think it's going to be interesting to look at whether there's going to be a plan going forward beyond 2017-18 as to what contribution rates should be. And I think thirdly, they will probably need to look at lifetime allowances, either because actually what is the point of lifetime allowances if you've got annual allowances, but if you do keep them, there is an inherent unfairness about it right now because of this factor of 20 that you have in final salary schemes, which ultimately means that somebody who's in a final salary scheme almost can get twice the income to someone in a DC plan before they're penalised by the tax system.
Tim, what challenges do you foresee?
Certainly see a lot of challenges arising from the point of decumulation. What is the role of the employer? What is the role of trustees in helping employees make correct decisions? Currently, they can direct people towards the PensionWise service, but there's a lot of work that could be done about providing information and guidance within the workplace, and this is something that Jonathan has done a lot of work with. There's a lot to be done about whether or not employer schemes really want to get involved in offering the freedoms at all. And there's been a lot of discussion over the course of the weekend about what employers should be doing. Historically, employers of DC arrangements have taken the view that once members have decumulated, historically they build an annuity, then that's really as much as employers need to do. I don't realistically see many employers wanting to get involved in offering drawdown or UF+, for example, from a trust-based scheme. So there's a lot of discussion that needs to be held within the industry as to what the future role of employers and trustees is going to be.
And Chris, what's your perspective and take on this?
Well, I think for employers in particular, there's still a lot to do with automatic enrolment. We find it quite easy to forget that the vast majority of employers actually haven't been automatically enrolled yet or been through the process. And even those that have, the larger employers, will now be starting to come up to re-enrolment, and so there'll be particular challenges for them, I think, in all of that. And for some employers, those in particular who still have defined benefit schemes, the introduction of the new state pension next year and the ending of contracting out will mean they'll have to be reviewing their scheme as well. And generally, I think all employers with automatic enrolment now will have an interest in pensions. There's going to be an awful lot of focus over the next few months and few years on both the cost of pension provision and the value that's offered by that pension provision, and I think employers are going to be very interested and are going to have a role in making sure that they know how much their schemes are costing, but what value their scheme members are getting from it.
Great. And I know since the new government came into effect, there's been a lot of talk about tax relief and the potential constraints or policy changes that the government may consider or introduce. Chris, I know this is a particular focus for yourself, so what's your view on that?
Yeah, it's an area that we've done a fair amount of work on, and it was very interesting just before the election that I think all of the political parties had a policy that affected tax relief in one way or another, although the vast majority of them were only looking at ways of reducing the value of tax relief, in particular for very high earners. There was no real focus on what tax relief could help people achieve or improving tax relief for people at the lower end of the income distribution. So I think that's an area where there might be further focus. Speaking about the Conservative Party and the government there is now, their proposal was to reduce the annual allowance for very high earners, which was quite similar to the Labour Party proposal for reducing the rate of tax relief for the very high earners. They're targeting a very similar group. And it'll be interesting to see if there's anything in the forthcoming budget which brings that manifesto commitment into fruition, or whether they're going to take an opportunity to take a step back and maybe start thinking about what the purpose is of pensions tax relief, what it is that it's trying to achieve, and whether actually the current framework that it's operating in with a system of lifetime allowance and annual allowances and marginal rates actually achieves that.
It's quite dangerous to disengage high earners from pension saving, and by reducing the amount of tax relief that's available, it's questionable just how much tax revenue this is going to raise, because you just have to wonder if people in that tax bracket are in a position to just consider alternative forms of tax incentivised saving. Won't they just go ahead and do that? Bear in mind as well that these are the fabled wealth creators that the Conservatives are so in favour of. Disengaging them from workplace pension provision is potentially a very dangerous thing to do.
Yeah, I mean, I think that whatever they do with the tax relief, one of the things that we shouldn't forget is that actually for people that are maybe at the lower end, I think it acts as a good incentive. And if we think about auto-enrolment and we think that actually maybe the contribution should be higher, I think what you don't want to do is pull away from a tax relief, which would then act as a disincentive. So you could argue that actually maybe that what you do with those on that pay basic tax is somewhat different to people that are paying higher rate tax. But even then, I think you get into quite a difficult ground, because of course people become higher rate taxpayers at relatively low income levels these days. So I suspect that even if you did something with higher rate tax, there'll be a lot of people that would see themselves as not particularly wealthy, having a disincentive to save and perhaps go beyond that 8% that is probably needed.
Great. I mean, one of the big changes one of the last big changes that came in under the previous administration were the pension flexibilities and freedom and choice. How do you feel those are currently working, and do you think further reform is necessary under the new administration?
Well, I think certainly trying to introduce major reforms over a period of just 13 months was hugely overambitious. There really did need to be a lot more thought. I mean, I for one was very disturbed at the way that this new regime was introduced. There was absolutely no consultation. It was done very much as a political manoeuvre rather than as a policy one. And so having just such a short period of time to introduce something so radically different was inevitably going to be problematic. So there's been a lot of discussion over the course of the weekend about the ability and willingness of providers to offer the full range of choices to individual members. And we do have to ask ourselves if it was realistic to assume that was ever going to be possible, given the timescales involved.
Yeah, I mean, I take a slightly different view on this, really. I think that any group of employees that I've ever asked, do they think that the freedom and choices is a good thing? Overwhelmingly, the answer is yes. So I think from a policy perspective, it's absolutely right, and it's absolutely what people want. The issue that we seem to be debating, and the issue that was in the press at the weekend and last week, was about that actually people are getting frustrated because actually this policy is a good policy and they're frustrated that they can't take advantage of it. But to that end, the thing that I think we're not thinking laterally enough about, or more creative about, is actually, well, who's going to provide that income, well, the guidance, the advice and the income as you go into retirement. And I think one of the problems here is that employers and trustees are looking to existing providers who, as we know, very few are unable to offer it, rather than looking at those companies that can offer it and are actually specialists in what often is called the decumulation. So they can give the guidance, they can give the advice, they can give the simple cash withdrawal, they can do the annuity broking, they can do the full drawdown. So it's companies like that employers and trustees need to be looking towards now, rather than the old guard, if you like, that clearly are failing employees and consumers.
Chris, what's your take on
I'm going to say, well,
issue?
I think we're very much at the start of a process which is going to take a long time to evolve. The people that we've seen going through freedom and choice so far since April are probably not very typical compared to how it's going to be when the people who've been waiting for a year or so to be able to do something different have filtered through the system. The research that we've done actually has shown quite clearly there's some real challenges involved. The individuals themselves don't really know what it is they want to do in retirement, so they're not quite sure what sort of product it is they might even want. And with that in mind, it's very difficult for product providers to try and to design something if they're not quite sure what the demand's going to be. There's a bit of a kind of chicken and egg situation at the moment. We're not quite sure what providers are going to develop because they're not quite sure what people are going to want to do. But some of the other research that we've done has shown also very clearly that people are finding this a very difficult decision. It's very complex. There's a lot to take in doing it. And actually what they want or might need more than anything else is, rather than having a specific product, is having a kind of strategy to know what they want to do. It's very unlikely they're going to find the right thing available now off the shelf that's going to last them the rest of their retirement. They're going to need to think about what they want at different points in their retirement and how they're going to achieve that. So it's not going to be very straightforward, I think. And something needs to be done to help the individuals, whether it's defining some default strategies that people might want to use or default pathways for them to use, or whether it's actually helping them with further guidance and further advice at regular stages. Something like that might help. On what's been happening recently with the kind of lack of options that are available to many people, I think the government actually knew this was going to happen at an event that we held just before the election. Steve Webb, the then Pensions Minister, was actually saying he would advise people not to rush into doing something. They knew that the market hadn't had time to develop a whole new range of solutions and a whole new range of products, and was saying it might be better to wait a few months and then see what's developed, and then you might get more choice to use your freedom with.
Sorry, I was just going to come on that because I think that one of the issues here as well is that people need to look at their finances in a holistic manner as well, because I think one of the issues that's materialising here is that there's very few people that have got just a single pension with their current employer, let alone other savings they may have, whether that's ISAs or maybe shares that they've been given by their employers. So actually in the new regime, because of tax, if nothing else, people now need to look at all their pensions lined up alongside any other savings they have that they may use to generate income in retirement. So even looking at your current pension provider or your current employer, if it's an occupational scheme, actually is not enough. You need that guidance and education to understand actually what are the full range of options that you have and how can you actually maximise your position as you go into retirement.
That actually brings us on very nicely to the first question we've just had in on using the hashtag EBWired. Robert Turner has asked, why do you have to take financial advice which you may have to pay for when opting to take money out of your own pension pot following the introduction of the new Pension Freedoms Act? Now, Jonathan, that's something you feel quite strongly about.
Yeah, I mean, I think there's a couple of things that are going on here that I guess needs to be understood. Is that often when providers, and I know some insurers have turned around and said you need to take advice, but often that's because they're actually selling their own service. So they're selling a drawdown product, and it's their company policy that if you buy their drawdown product, you have to take advice. Now, that's, if that's their commercial model, that's fine. But what they can't stop you doing, and the regulation is very clear about this, what they can't stop you doing is transferring that pot of money to a third party who may be able to do something for you, with or without advice. So, for example, people can transfer pots to us to do simple cash withdrawal, and you do not need to get advice to access that service. So, I think the first thing is that understand that often they're insisting on advice because they're actually selling their own product. I think the other thing just to mention though is that for a lot of people, taking regulated advice is probably not a bad thing, because what you've got to remember is you're looking at these multiple pension pots, maybe a mix of DC and final salary. You're looking at these other assets. You're looking at the tax position, and actually you're making what may be a first of a number of decisions, but those decisions may need to last 20, 25 years. So actually taking advice is probably not a bad thing to do.
I'll go along with that, absolutely. It's people are making very important decisions, and I think it's time that the public was a bit more realistic about the value of financial advice rather than the cost, and to think about that paying, for example, say £1,000 to have a session with an IFA to sort out their various different sources of retirement income and other assets as well. It's an important investment, and I certainly would think it's something these days that most people ought to consider.
Yeah, I mean, I think to go back to a couple of Jonathan's earlier points, I mean, one, it's important that this is considered in the context of all the assets that people have, and so actually what might seem a very obvious thing to do with a single pot might end up having some quite important implications for the other assets and savings that you have. But secondly, it's also, I think, apparent that a lot of people really don't necessarily understand what they already have. And in particular, there are certain products out there which might have guaranteed annuity rates attached to them, something like that, which people might be giving up unwittingly without realising. Especially when you talk about annuities, people tend to think automatically that's a bad thing. So they might think there's a guaranteed annuity rate attached to their product. They might not understand that's actually probably a much better annuity rate than they'd be able to get on the market, and could actually be a very good investment for them. So I think it is important that people are fully aware of what the implications are of the decisions they're making, and if that means they need regulated advice, I think in some instances that has to be a good thing.
So in your opinion then, should the government be looking at introducing further measures to help educate individuals about pensions and savings issues?
Well, I mean, this is a very long-term thing. It's not going to address the immediate problems that we've seen over the short term. But there has for a long time been a movement to get proper financial education on the school curriculum, which would certainly be helpful. There's a degree of naivety amongst the general public about financial products, and getting people to have a rather more realistic understanding of these things is something that we really need to start working on in childhood. Beyond that, I think there needs to be more work at getting people to attend a pension-wise session. The number of people currently booking pension-wise sessions is disturbingly small. It's less than 1%, I think, of those eligible to do it. And I would also like to see pension-wise extended so that its remit covers those with defined benefits as well.
Jonathan, do you have anything you were nodding along to that? Do you have anything you wanted to add at all?
Well, the only thing that was crossing my mind is that we were talking about tax relief a moment ago and what the government may do about that. I mean, one of the interesting areas I think is actually whether some sort of tax relief could be given, particularly in the workplace, to provide guidance and education. Because I think the problem we've got here, and perhaps why pension-wise has not had the take-up that maybe some anticipated, is that you've got your pension from your employer in most cases, so it's a natural place to get that guidance. I think as soon as you go off to a third party who you have no relationship with, all of a sudden there's a disconnect there, which is perhaps why there has been low take-up. So maybe if there was some tax relief given to help provide that guidance and that education in the workplace, actually take-up would go up significantly.
Yeah, I think education, awareness, guidance, engagement, whatever you want to call it, is going to be very important going forward. Although automatic enrolment has been introduced to use inertia to help people to start saving, as we've already talked about, it's very unlikely that people just saving the minimum through automatic enrolment are going to end up with enough by themselves in retirement to have a comfortable retirement unless they work much longer or have other assets. It's very likely they're going to have to save more than just the 8%, which we have to remember is not 8% of all their earnings, just 8% of their band earnings as well, which for many is quite a small contribution. But unless you see big increases in the minimum, which we may see some changes there, or the use of things like auto-escalation to encourage people to save more, a lot of it's going to come down to individuals deciding that they need to save more. Tax relief could have an impact directly on that if it was made clearer what the benefits of saving were in tax relief. I think the current tax relief, although it can provide a good incentive for basic rate taxpayers, is pretty poorly understood. If that was clearer, that could help. But I think actually engagement with that and then people understanding more about what it is that they're saving into and what it is they might need in retirement is going to be a very important part of that. Now, some of that might happen naturally. We've seen in other countries where they have more developed, more mature defined contribution systems, Australia and the US, for example, that once individual pension pots get to a certain size, actually people start to become much more interested in them when they see that it's worth the value of a new car or it's how much they earn in a year they've got saved up. Actually, it then starts to be meaningful for them and they do start to take an interest themselves. Now, we're quite a long way off that at the moment, but as I said, as with the freedom and choice, this is a start of a long process, and hopefully if the process is there long enough to bed down and people start to become more aware of what's happening, if automatic enrolment becomes normal, if people start to talk about pensions, then maybe that engagement level will start to increase automatically.
Actually, the talk about auto-enrolment and the new sort of groups that's brought in to pension savings for the first time actually leads very nicely on to the next question we've had in from the audience. Richie Calver has asked, is the government doing enough for those short-term contractors and freelancers which are making up an increasing part of the workforce?
Well, under auto-enrolment, if they are the nature of first of all, you have to establish what the nature of the employment contract is. If they are workers for the purposes of auto-enrolment, then these are people who are probably going to be non-eligible job holders if they're going in for on a short-term basis. It's difficult to judge overall terms, so you have to look at these case by case. But if they are non-eligible, then they do at least have the capacity to opt into saving rather than being enrolled automatically. And that's something which, if it's available to them, then of course they should take advantage of it. Bear in mind as well that low earners historically were considered not suitable people for auto-enrolment. That's all been changed by freedom and choice, because people now have the option of saving for what will probably be a useful lump sum when they come to accumulate. So I think the government is probably doing a reasonable job, the options that are available to people. So it's difficult to make a hard and fast case for saying that it should be more.
I think it's a difficult one, but it's an area that we're very interested in finding out a bit more. One of the really surprising aspects of automatic enrolment to me is if you look at the monthly figures from the pensions regulator who are monitoring the market. Although there have been just over 5 million people automatically enrolled since 2012, there's also been 5 million people working for the same employers who don't qualify for automatic enrolment, and that to me sounds like a lot. I think when we go back to the Pensions Commission discussions, although the very low earners were kind of outside automatic enrolment, it was at that time envisaged if you're paying national insurance then you'd be automatically enrolled, whereas now you need to be earning over £10,000 a year. So it's quite a big group. Some of whom are going to be low earners, part-time workers who aren't covered, but there will be some of these on non-standard employment contracts who aren't covered, the self-employed aren't covered, and they're not covered in the figures we've been talking about already. So there's this kind of under-pensioned group, I think, where we don't know whether them not being automatically enrolled is going to be important or not. It depends whether people stay in that group all the way through their lives, whether they move in and out, and how it happens. So I think we need to do a lot more to understand who it is who's in this group, and what actually, if they miss 1 or 2 years of automatic enrolment and employer contributions, that might not matter. If they're missing 10, 15 years or more, then actually they could be the groups which we're finding come up to retirement. And it doesn't matter what freedom and choice or options they have. If they've got such a small pension pot, they're not going to have a lot of option to improve their retirements.
Something that's frustrating about the pensions regulators' statistics that they publish on a regular basis is that it doesn't tell you things like, for example, how many people are opting in. And it doesn't give proper persistency rates as well. So although we have rates for people who are opting out, we're not having that combined with the longer term business of people leaving schemes. So it would help if we had a much clearer idea in terms of statistics about people who are actually contributing to workplace pensions.
Great. We've actually just had another question through from the audience. Sean has asked, in terms of pensions provision, how do we compare with some of our European cousins?
Difficult to make a like-for-like comparison, particularly on the continent where there is far more reliance on state benefits, that there are different systems of workplace pension provision throughout the European community. And it's actually quite difficult to make a proper apples with apples comparison. France has these card rate pension schemes, which are sort of all employer type arrangements. The Dutch have a system which is probably more comparable to ours, although they do have these very large occupational schemes. They've got a small number of very large schemes. And there, of course, they have the provided typically through the collective DC model. It is difficult to make proper comparisons. Historically, of course, in the UK, we've had a very low state pension because the understanding is that the occupational sector would carry most of the work in that respect. And I would suggest that whilst there are other countries that might still offer far more in the way of state benefits these days, that is, in demographic terms, that's a very difficult thing to sustain over the longer term.
Yeah, I mean, I think that's right. Certainly, the UK level of state benefits is much lower than most of continental Europe, if not all of continental Europe. And the UK system is quite different from that that's operated. I remember we used to claim there were more funded pension assets in the UK than the rest of Europe put together. I'm not sure that's still the same. I think what's different about the UK is we do have now much more of an individual focus on provision for retirement. Some of the other well-funded states, such as Denmark and the Netherlands, and even Sweden to a certain extent, have much more of a focus on collective provision. Especially in the Netherlands, for example, the level of contributions going into pensions are much, much higher than they are in the UK. So the average contribution from the individual in the Netherlands is about 20%, so almost 1 day a week they're working for their pension and their retirement. If you compare that to the levels we have in the UK, there's really no comparison.
We're very nearly out of time, but just to conclude, I'd like to ask each of you the same question. So what one action would you like the government to take around pensions above anything else? So if we start directly to my left with Jonathan.
Well, I think the freedom and choice issue is such a big issue now that I think there needs to be a public awareness campaign funded by the government, which says that the rules allow you to transfer. Don't worry about your existing provider offering you the flexibilities. You have the right to transfer your pension to whoever you want in order to get those flexibilities. And there's lots of people out there that will give those flexibilities. So I think there needs to be an awareness campaign along those lines. I also would like to perhaps look at getting more guidance and education in the workplace, and maybe the government should look at some sort of tax relief to ensure that happens on a wide scale.
Yes, I'd echo that last point in particular. I think that would be very helpful. But I think for me, I think probably the most important thing the government needs to address now is sorting out the tax rules. It's only been 9 years since we had the current tax regime introduced. In the interest of promoting simplicity, perversely enough, we've now gone to a situation where it's now become horrendously complicated. We suspect that come July it's going to get even worse. And so what I would really like the government to do is sort out the tax rules. It's desperately important.
Okay. I think there's been so much change over the past 5 years or so, at least legislated, that hasn't all had time to bed down in every major area of pension provision in the UK. I think what would be really helpful is for the government to take a step back and have a look at how all the different parts gel together or mesh together, and what the overall outcomes for individuals are going to look like as a result of all the reforms coming through, what's going to happen in 10 years' time when they've all bedded down, and then see where the gaps still are then. I'm sure there will still be some gaps which will need further work.
Great, thank you. I know I said that was actually going to conclude. We've just had one final question in, which I'd quite like to pose to you to share your expertise. Following recent press reports, one provider has publicly stated that they're not going to offer flexible drawdown. So do you feel, is this the start of organisations looking at the cost they're going to incur in implementing the pension freedom reforms? And do they have a choice on what part of the pension changes they can offer? And is the regulator likely to be stepping in to ensure people can access their savings as outlined under the pension freedoms?
Well, I think I'd start off by echoing some of the points that Jonathan was making earlier, is that people are at liberty to transfer benefits. If they don't like the deal that the current provider is offering them, they can go elsewhere. I think it's a rather dangerous business for government or anybody else to be dictating to providers, making commercial decisions on their behalf as to what they should or shouldn't be doing. If we can have a proper, genuine, open market, then if people have an opportunity to move their benefits to somewhere else who's going to do a better job for them, then let them go ahead and do it.
Yeah, no, I mean, I completely agree with that. I think the issue that we've got to address here is that people have the right to move their pension wherever they want under the rules. So we don't need any more regulation. They're allowed to do that under the regulation to get the flexibility they want. The issue here is that I think because of the short time scale, I think there's a lot of employers and trustees out there that are demanding, because the accumulation of the pension was with a certain administrator or certain provider, they're now trying to insist that provider does the decumulation But why are they doing that? You know, I mean, you could be quite harsh here and say, well, actually, trustees and employers need to now start thinking about, you know, the people that you accumulate your pension with are not the experts and the specialists that your employees should be going to for the decumulation. So you know, why are you trying to get them to do this? They're not actually, arguably, even the best people to do it. There are other more specialist people out there that can do it. So I think, you know, two things really. You have the absolute right to transfer your pension wherever you want, so we don't need any more regulation change on that. And secondly, employees and trustees need to think broader than the supplier base that they have at the moment for the accumulation phase.
Yeah, I agree. You have to be very careful about almost forcing providers to provide a particular product if they're not interested in doing it. You just have to look back at the history of the annuity market, where a lot of the issues were from providers who really weren't interested in annuity business but had to provide an annuity. And because the transfer market didn't work, a lot of people ended up with annuities that they didn't want, weren't very good value for them, their provider didn't want to provide. So it wasn't really a good deal all round. As long as there is the ability to transfer easily and people can know that they're going somewhere better, then I don't see why you would need to force anyone to provide any particular product.
One thing I think we should add, though, is the risk of scams is as real as ever as it has been, and anybody considering transfers does need to be aware of the risks that there are.
Great. It sounds like there's lots to talk about. There are lots of food for thought, but unfortunately that's all we have time for this morning. I'd like to thank all of our panellists, Jonathan Watts-Ley, Tim Middleton and Chris Curry. Thanks for watching and for all of your questions.